Welcome back to Descript with Henry, the podcast where we break down complex financial ideas into everyday language. I'm your host, Lisa, and today we're diving into a topic that has generated both massive hype and deep skepticism: cryptocurrency. Now, whether you've heard about Bitcoin from a friend, seen influencers talk about altcoins, or even considered investing your own money, the crypto space can feel like the Wild West. To help us understand the landscape, the risks, and the real potential behind crypto, I'm joined by someone who's been watching and guiding people through this space for years. Henry is back with us. Thanks so much for being here, Henry.
Thanks for having me, Lisa. This topic is incredibly timely, especially in 2025, as we're seeing more people than ever dipping their toes into crypto, often without fully understanding what they're getting into.
That's what inspired today's episode. I've spoken with so many people who say, I want to invest in crypto, but I don't know where to start. Or worse, I just bought some coins because a YouTuber said it would 10x. So today, we're going to break down the 5 most important things that every investor should understand before putting money into crypto. Let's start with number 1, a big one: volatility. When people hear that crypto is volatile, they might imagine the price going up and down a little bit, maybe like tech stocks. But the reality is often way more dramatic. Henry, can you help us put that volatility into perspective?
Absolutely. Crypto volatility isn't just high, it's often extreme and emotionally taxing. Let's take a real-world example: Bitcoin, the most well-known and widely adopted cryptocurrency. In 2021, it started the year at around $29,000, hit an all-time high of nearly $69,000 by November, then fell to around $16,000 by the end of 2022. That's a drawdown of more than 75%. And we're talking about Bitcoin here, the blue chip of crypto. Now imagine investing in a smaller altcoin. Many of them swing 30-50% in a single week, sometimes even in one day, driven by speculation, low liquidity, or sudden news.
That kind of volatility is hard to stomach. I can imagine people panicking and selling at the worst possible time.
Exactly. Emotional investing is dangerous in crypto. Many people buy high and sell low because they react to market swings. If you don't have the emotional resilience to handle those price movements, or you need access to your money in the short term, crypto might not be the right asset class for you.
So would you say this is more suitable for long-term investors?
Yes, and only if you can afford to take the risk. Volatility is both a threat and an opportunity. But you need a strategy and a strong stomach.
Let's move to point number 2, which is about quality. There are thousands of cryptocurrencies out there, over 20,000 listed on aggregators like CoinMarketCap. Some have strong teams and real use cases, others, not so much. How can someone separate a legit project from a potential scam?
That's such a critical question. In the traditional stock market, companies have to go through regulatory scrutiny before going public. In crypto, anyone can create a token with just a few lines of code. There's very little barrier to entry, and that leads to a flood of low-quality projects. I always advise people to look at fundamentals. What is the project trying to solve? Does it have an actual product? Is there a development roadmap? Who's behind the project? Are they credible and public-facing? Are there real partnerships or adoption metrics? Let's compare Bitcoin to a meme coin like Dogecoin. Bitcoin has over 15 years of history, is supported by institutional infrastructure, and is recognized by governments. Dogecoin started as a joke. While it did gain traction, largely thanks to Elon Musk's tweets, it has no core development team actively improving the technology. And that's the case for hundreds of other tokens.
So hype alone isn't enough to justify an investment?
Absolutely not. In fact, hype is often a red flag. If everyone is suddenly talking about a coin and the price is spiking quickly, that could be a classic pump and dump.
Would you say 90% of these projects will disappear in 5 to 10 years?
I'd say that's optimistic. Some estimates suggest that 95 to 99% of altcoins will eventually go to zero. That's why diversification, due diligence, and skepticism are so important.
Now let's talk about regulation. A lot of people still associate crypto with the Wild West, completely unregulated, decentralized, and free. But that's changing, right?
It is. In fact, regulation might be the biggest story in crypto over the next few years. Governments all over the world are waking up to the scale of crypto adoption and the risks. In the US, we've seen increased enforcement actions from the SEC and CFTC, including lawsuits against major exchanges like Binance and Coinbase. There's ongoing debate about which tokens should be treated as securities versus commodities, and that directly impacts what's legal to offer or trade. Europe is ahead of the curve with its MaKe regulation, which takes effect in 2025. It creates a unified legal framework for crypto across all EU nations. That includes requirements for stablecoin reserves, consumer protection, and anti-money laundering controls.
And for regular investors, what does that mean? Could some coins become illegal to trade?
Yes, or at least restricted. If a token is declared a security and you're not an accredited investor, you may no longer be able to legally buy, sell, or even hold it on certain platforms. And if the platform itself isn't compliant, it could be shut down, leaving you locked out of your funds.
Wow. So regulation isn't just a headline. It can directly affect your portfolio.
Exactly. That's why it's crucial to use licensed, regulated platforms when possible and to keep up with regulatory news.
Okay, moving to number 4, security. This is a big one. We've all heard horror stories about people losing their crypto due to hacks, lost passwords, or scams. How can the average person protect themselves?
Crypto is unique because it puts you in control, but also gives you full responsibility. If you're using a centralized exchange, you're trusting them to secure your funds. But as we saw with FTX, MaKe, and others, even big exchanges can collapse. If you go the self-custody route, like using a hardware wallet or MetaMask, that's great in terms of decentralization, but it comes with risks. Lose your recovery phrase and you lose your money. No password reset, no tech support. I always recommend people do the following. Use hardware wallets for large amounts. Keep your seed phrase offline in multiple secure locations. Avoid clicking on links from random DMs or emails. Phishing is rampant. Turn on 2FA, two-factor authentication, for all your crypto accounts.
So it sounds like crypto investors have to become their own bank.
That's exactly it. You're the bank. And with that comes both freedom and responsibility.
Our last point, and I think this might be the most important, have a strategy. So many people treat crypto like gambling. What's your take?
You're absolutely right. A lot of people enter the space with unrealistic expectations. They see headlines about people making millions from early investments and think, that could be me. The truth is, most people lose money when they invest with no plan. You need to ask yourself, why are you investing in crypto? Is this a short-term speculation or a long-term hedge? What percentage of your total portfolio will you allocate? Are you okay if it goes to zero? A common approach is to allocate 1 to 5% of your total investments to crypto. That way, you're not overexposed. Also, consider dollar cost averaging, putting in a fixed amount regularly, regardless of the price. It helps smooth out the volatility.
So no all-in bets on the latest trending token?
Definitely not. Crypto should be part of a diversified portfolio, not your entire financial plan.
Let's summarize everything we've covered today. 1. Crypto is highly volatile. Be prepared for big price swings. 2. Most coins will fail. Do your homework and invest only in strong projects. 3. Regulation is growing, and it will affect where and how you invest. 4. Security is your job, especially if you self-custody. 5. Have a clear plan, and don't invest out of FOMO or hype.
That's a great wrap-up. Crypto can be rewarding, but only if you respect the risks and do your research.
Thanks so much, Henry. This has been incredibly informative, and I think a must listen for anyone even thinking about entering the crypto market.
Always happy to share, Lisa.
And thank you to everyone listening. If you found this helpful, don't forget to subscribe and share this episode with someone who's curious about crypto. Until next time, this is Descript with Henry.